Hey everybody, welcome to the Real Vision Daily Briefing. Today it's Tuesday, January 11th, 2021. This is Alf, the author of the Macro Compass, and I'm here with the one and only Tony Greer, who's the editor of the Morning Navigator. Hey Tony, how are you doing, man?
Alf, how are you today, brother? What's happening?
Yeah, it's all nice and dandy, you know. We have all these rallies going on. Everything that has a name attached to it, it's rallying apparently. You want to call it? It's bonds, gold, Bitcoin, tech, cyclicals. You just call it. Everything is rallying, right?
Yeah, I mean, we tend to have days like that whenever there's a presence of Jerome Powell on the tape anywhere. If you ask me, if the Fed chairman speaks, markets are buoyant. I think that's his job.
Probably. So today he showed up at the Senate Banking Committee, and he gave, his speech there. And, he said a couple of interesting things. But before we talk about what he said and the reaction of the markets, I just want to make sure that the audience actually listens to an interview I had, a clip to an interview I had with David Rosenberg, where we actually talked about his view of the Fed and what he thinks something pretty interesting. Let's listen in for a second.
I never understood why the Fed gave up on transitory. Maybe they just should have defined it. Because to me, in the overall realm of economic and financial history, 1 to 2 years, to me, is still pretty transitory, or maybe we need another word for it. But you see, the household sector is telling you that beyond this year, with the supply bottlenecks and the commodity pressures that we've seen, that their 2 to 5 year view is inflation to average 2.4%, which actually is the low end of the range of the past several years and below where it was when the pandemic started. And so something's happening here that's very interesting. We all bellyache about inflation, but then again, it's staring us in the face. But the bond market doesn't move on what is staring us in the face for the here and now. It's really looking out many years. And you got to believe that if the Fed starts to pull the rug on liquidity, and understanding that this has been a liquidity bull market in residential real estate, in cap rates, in corporate credit, and in the equity market, what is going to happen when interest rates start to go up? And the key here again is the shape of the yield curve is half as steep as it normally is at this stage of the cycle before the Fed starts hiking rates. So we might not be beyond 3 or 4 rate hikes before we start talking about recession pressures.
And the full interview is available on the Essential tier at Real Vision. But Tony, you gotta believe, as David Rosenberg said, that if the Fed pulls liquidity out of the market and they try to hike 3 or 4 times, what's going to happen, Tony? I mean, David thinks everything is going to go belly up. Do you have a different view?
No, I think we're going to be in an extremely violent rotation, Alf. That's my plan for this year. Coming up until the first several sessions of the year, call it all 5 sessions of last week, essentially, we saw natural resources outperform technology. And I really think that technology is going to be at the center of the rate rising storm for equities. I do believe that it can have an ultimately negative effect on the indices, but I still think that you're going to have some bull markets within the indices in natural resources, in oil, in metals and mining, probably in grain sectors and a lot of ag sectors that are going to hold together just fine. And while net, it may take the S&P lower, I don't think that we're in a curl over de-risking phase by any stretch of the imagination, just because we're talking about higher yields.
All right, so let's talk for a second about higher yields, because that's the backbone of your bullish cyclical commodities thesis, right, Tony? So I pulled up a chart for the viewers and for the listeners. I'm just going to walk you through the chart. It simply shows the number of 25 basis point Fed hikes that the future market is pricing in by December 2022. And, in October, we're talking literally about, let me see, it's something like 3 months ago, the market was pricing 1 hike by the Fed by December 2022, just 1 hike. And now we are at 3.7 hikes by December 2022, which means 3 hikes for sure and 70% chance of a 4th hike in 2022. So obviously, Tony, the market is adjusting to this perspective that the Fed will deliver in tightening. Don't you think that, this is already priced in the bond market to a certain extent, and therefore as well in the commodities market? Can this not be a headwind to your cyclical commodity bullish thesis?
It sure can. It sure can, Alf. And I'm on the lookout. I guess I'm on the lookout. There's a lot to go over within that, right? But I guess I'm on the lookout the most for, for example, Powell's comment that anything about the balance sheet, where he says the runoff may be sooner or faster than the last cycle. He said that the balance sheet is far bigger than it needs to be, which is the God's honest truth, probably. And when he lobs bombs like that out about actually taking down the balance sheet, the market seems to create the perception of the sort of most hawkish scenario, right? So I feel like right now, where, as you said, Alf, 3 months ago, when Powell was hanging his hat on transitory inflation and not really changing his posture on that, we weren't looking at any rate hikes for this year. And now, as soon as we get here, remember that was via Jerome Powell very much pivoting, the Federal Reserve ship into saying, okay, fine, this inflation looks like it's going to be with us for a little while. We're going to use our tools to manage it. And therefore, the market took a dip on that just with the prospect of higher rates and a little bit less liquidity that we've seen. But as you can see, for example, I do think that these rate hikes are very much getting priced in. I do believe that we'll hit rough patches in the economy, and even for the inflation cycle next year, that will swing that pendulum maybe back to, oh, you know what? Maybe it's just 2 or 3 rate hikes this year. Maybe 4 was a little bit aggressive. Because I still think that this year, Alp, we're going to see the push and pull of inflation and deflation. And what I can get excited about, if the Fed hikes are priced in, is what I'm seeing today, where the dollar can back off a little bit. Because if the dollar can, God forbid, back off, Alf, then I am going to step on the gas pedal with both feet of my natural resources trade.
Well, I can see why you would do that. I mean, the point I'm trying to pass across to listeners here, Tony, is that, as I tweeted today as well, actually, it's very difficult to jump on a trade if the news is already out. And the news that the Fed will hike is already out, and it's fully priced in the market. There are 3.7 hikes priced in. 10-year bond yields, and 30-year bond yields, they try to breach 1.8 and 2.1%, 2.15%. Yeah, well, they hardly could. Of course, they could go a little bit further, but it seems that the market sort of woke up all of a sudden to the idea the Fed's going to hike and is going to taper their balance sheet, reacted accordingly in the bond market, and commodities as well. Actually, cyclical commodities overperformed defensive commodities like gold. I pulled up another chart, and I want your opinion on that, Tony, which shows the oil to gold ratio. So I literally measure oil prices instead of dollars. I measure them in gold. It just shows the over or under performance of oil against gold. That's the blue line, and 10-year yields in America. You can see they correlate very well. Not a big news. If the economy is pretty hot and it's running nicely and nominal growth is priced to go up, then oil consumption is also priced to increase, and therefore oil prices go up, ceteris paribus, and actually gold doesn't perform very well in that environment, and vice versa. If the economy is slowing down, real rates are dropping, aggregate demand is not that strong, then gold tends to perform oil and yields drop. But look at basically the scissor, which is opening in this chart between 10-year yields and oil to gold ratio. So oil has overperformed gold over the last few weeks, few months actually, as you have pointed out. But 10-year yields cannot keep up the same performance on the way up. I mean, why is that?
That's a great question. That question for the inflation people like me, that's the question that's kind of plaguing us about the bond market, Alf. And luckily I don't try my hardest to understand the bond market. I don't have that kind of capacity. I just try to use it as a mechanism to help me understand what the world thinks right now. And when I look at when I look at 2-year paper, which has gone bidless with this most recent leg of the commodity rally, and maybe the 10-year there at the center of the curve isn't going along with it as much. Maybe there's a lot of curve adjustment going on right now. But I feel like when I look at, I still see 10-year yields breaking out of a pennant flag and going higher. We're just bumping into some resistance at 1 3/4, where we had a high in the middle of last year, early in the year. That makes sense to me for the bond market to sort of slow its slide as yields get to that price. I think that no matter what, the long end is probably going to be kept, in check, as it always has been, because that's really the mechanism by which the whole mortgage application and housing boom has been running. So I think that they'll be loath to take that punch bowl away in the long end, while in the short end, they have to just, really make sure that they're making adjustments for the inflation that's hitting the tape and the commodity inflation that we see. I'll be really interested out to see where bonds shake out at the end of this week. We've got CPI and PPI coming up tomorrow and Thursday. And the reason I focus in so much on those numbers more as an equity ranger is because if you remember last May, we got that first headline CPI number that was way out of above expectations. We had a huge sell-off in the stock market, and we registered the most significant downside tick extreme of the year, where just everybody was bailing out of stocks. Now, that was at an S&P price of 4,000, right? We're much higher than that, so it proves that the market can bear higher yields and all this inflation. I just think that we're at a little bit of a crossroads trying to decide what the Fed is going to actually do and what they're going to be able to do in terms of tapering and, maybe bringing down the balance sheet a little bit. To me, that would be, something that would cause me to make a lot of sales in stocks and sort of lighten up the load a little bit. But, the way things have gone now, it feels like the market can bear really whatever the Federal Reserve is throwing at us. We've got a lot of economic, sort of cyclical pent up strength that I think is going to be let loose as we come out of this pandemic. And I'm just hoping that things hold together and we can get cyclicals holding up while technology falls in equities. And that's really the way I'm looking at it, if that's fair.
Wow, so much juice in this answer, Tony. So let me try to break it down a little bit.
Okay, let's do it.
So one very interesting thing that you said is, when we talk about the bond market, we're literally talking about two different beasts, the short end and the long end.
Yeah.
So, 2-year yields are now 0.9%, pricing in basically 4 hikes by the Fed by the end of this year. So that part has reacted. Yeah. And also the fact that, consumer spending and the labor market is still relatively buoyant. So it's true that, the fiscal stimulus effect is probably fading away a bit, but the consumer side of it and the labor market side of it are picking up the tab. And, so the Fed can literally try to react to the front end and tighten monetary policy. So that's one side. But the other side is actually the long end of the bond market, which isn't following up that much, which is making the curve very flat. That one is driven by long-term forces. And there the market is much more dubious that things have actually changed in the long term. But what drives commodities, as you were saying before, and we are trying to overlay these two components, the bond market and cyclical commodities and defensive commodities, is more about the supply and demand imbalance short term, at least for the front contracts of these commodities. So those two things can actually square. Commodities can rally, even if the long end of the bond yield of the bond market doesn't manage to break on the upside. Sure. So that's quite important. Yeah. And and the other thing is obviously quantitative tightening, which is the topic du jour. And a few months ago, nobody was talking about it, and we were even doubting whether the Fed would go for tapering. Quantitative tightening is quite of a different beast compared to tapering. You're not increasing at a slower pace the purchases. You're literally halting the purchases, and you are reducing the size of the balance sheet, which means the mechanism for which before you drew collateral away from the market, you just put it in the black hole, which is the Federal Reserve balance sheet. You just removed it from the private sector risk-bearing capacity, and you gave the private sector reserves, just zero duration, zero risk stuff that sits there on the balance sheet. You created this imbalance, and now you reverse it. Yeah. So you basically say, sorry, guys, I'm going to take the reserves back, and you have to absorb the private sector, more bonds, more duration risk, more credit risk, and it's all back to you guys. That's quite a different dynamic. That's pretty relevant.
100%. I operate every single day, Alf, from the perspective of two things. Number one is waking up bullish because I'm a secular bull and I try to keep that position with me no matter what I'm doing. And number two is the Fed is inflating assets. And if you have assets, you're going to be okay, right? So if they start cutting down the balance sheet, you can make the argument that they are obviously not in the mode of inflating assets as much on their own, but rather letting the market do it where the market can. And so I think that they're benefiting a little bit from that commodity strength that's been ignited. That was the strength that they've been trying for since the great financial crisis, right? And it has been nothing but a deflationary war, a deflation story winning that war for so long. Now we've got a couple of different dynamics with a much different energy market than we've had in 10 years. We're heading into the commodity, not to switch, I guess I'm switching back. I don't want to switch to different asset classes like that on you, but we've got a very different situation under the hood than we had even a year or two ago, where, it's hard to compare to the lockdown situation, but there's a lot of economic momentum coming out of here that, quite honestly, it seems like with the S&P at 4,700 and 2-year notes yielding 90 basis points, the market is okay with it. So like you said, I'm dying to see what is going to be the direct cause and reaction to what happens if they, start nibbling away at that 8-point-something trillion dollar balance sheet. Right, that to me will be something that will definitely cause me to hit some bids with my natural resources trades and take a fresh look. I think that's what the whole predication of this bull market move has been about. So I am definitely on my toes, given that's a new topic that we're talking about now.
Yeah, and actually, we often talk about indexes too. We talk about, the S&P or the Dow Jones, but as you said, under the hood, a lot is going on, right? There's a lot of rotations. There are, a lot of sectors that are overperforming or underperforming. And the topic of the last 2 weeks has been the underperformance of the tech market, or we should say actually the highly overvalued, non-profitable crap, which sits in stuff like ARK and the likes, right? So, and all of that actually, basically the financial theory behind that, supporting those valuations, extreme valuations, should be that because the cash flows are so much further in the future, you can't even see them in some cases, like Rivian, for example. But because they're so far away in the future and you're discounting them by a certain discounting factor, then if this discounting factor being risk-free real interest rates goes up, then the present value of these cash flows goes down and therefore stock prices go down, right? So these are the most high beta sensitive asset classes to rising real interest rates. I just plotted this chart as well for people that are listening and not seeing it. It shows how real interest rates inverted in the chart actually lead tech stock valuations. So I just took the 5-year real interest rates in America, that's blue. I inverted it. So if the line is going down, then real interest rates are actually going up. And basically I plotted it against tech valuations. So there is quite a good correlation. If real yields go down, then tech valuations go up and vice versa. Now, real yields have been moving higher by 40 basis points year to date, which has obviously made valuations on, the most valuation intensive side of the stock market nosebleed, and therefore stock prices also move down. So this rotation under the hood, Tony, what do you think about that?
Yeah, that's my, that's the call for the year, really, Alf. That's what that's where I've got my chips placed on the table right now. I've begun shorting some technology. Didn't short it well, but kind of just decided that as yields are obviously not backing off, that might be a decent place to have a more balanced book. And by putting out some technology, obviously we got to this point where Cathie Wood's ARK became, a focal point, and everybody is, going through the due diligence of understanding all of her withdrawals at the end of every day, and it just must be really hard to operate under a microscope like that. But unfortunately, she's, replacing, liquid tech stocks with smaller, less liquid holdings, and it hadn't worked out for her for a while. So, that is sort of between ARK and between Bitcoin and Ethereum backing off, you've got that side of the equation nailed, right? Everything that is the highest risk technology has got to back off. you look over at the Bloomberg Commodities Index, and like oil, they've gone what I call blue sky trading, which is where a security in a bull market dips to its moving averages and maybe trades below them, and then regains its moving averages and resumes trend. So with the commodity sector doing that, in fact, while Powell is talking about, that the balance sheet is too big, today is probably the most hawkish Powell I've heard since he's been in office. And I'm shocked that the market's hanging in there. Gold's rallying, commodities are rallying furiously. And if you look at the tape, the only thing different today is that technology is recovering with the natural resources rally. And that's something that we haven't seen, and that fits with the bill of every time, we have a Fed chairman speaking, it's like an all risk on rally in every asset class you can find. So today, you've got commodities at the top of the leaderboard, being led by oil services, gold miners, and Bloomberg Commodities, but you've got technology right in there with them, which is just short covering from the damage that's been done. So there's going to be this ratcheting effect, Alf, that I'm expecting, where we're going to hit technology, the S&P is going to back off, natural resources are going to keep rallying, and the S&P is going to hold its ground. Net, it's probably going to have a harder time rallying than it has in the last several years when it was full punch bowl for the low valuation stocks, as you beautifully put together there. So now, with that dynamic changing, I think you really got to be on your toes more than ever. And this is coming from someone that's really a non-shakable secular bull. So my guard is up, and I'm very much watching this commodity trade stay on its feet right now while we talk about raising rates.
All right, Tony. So we have a couple of interesting questions from the audience, and I'm going to ask you if you're ready to fight, because a couple of those actually put us one against each other on the stand.
Oh no!
Because they pointed our views, which can be conflicting, of course, because otherwise we won't have a market, right? If everybody agrees. So we have Gonzalo and also Daniel actually asking basically the same question, which is Alf is long bonds and long tech, and Tony is rather long cyclicals and hard assets. Is there an asset allocation you would rather agree on that would do well in both of your views? And what development would have to occur for each of them to change their mind? You take it first, Tony.
Oh, that's a good question. If I would have said something potentially, it's getting away from, if you are bullish bonds, I'm a little bit bearish bonds, but like I said, I don't have a position on. I use them to tell me something about what the market thinks. I would have thought something like financials might be a middle ground where you and I could agree. However, if you think rates are going to back off quite a bit, maybe you don't want to be in financials. But that's kind of the direction that I go if it turns out that some of the natural resources stocks that I've chosen, whether they're, in the ag sector or whether they're one of the metals and mining sectors, if that doesn't work out, I would think that I'd be pivoting, for me, in a higher rate environment, looking for financials to survive, et cetera. But you might not be bullish those. I'm not sure if there is a direct overlay in between our views right now. Alf, what do you think? What would your answer be?
Well, maybe the overlay is in the long-term asset allocation. So I want to stress out this point. There are two ways to approach markets. There is a long-term asset allocation, and there is a tactical long-short tilt, right? Those can be very different because the time horizons can be very different.
Totally.
So in the long-term asset allocation, as pointed out in the Macro Compass Endgame, which is my latest article, I talk, for example, about the role of gold in long-term asset allocation portfolios. So, I treat that basically as a positively convex payoff that costs me a certain premium or a cost opportunity to hold over the long term, but it gets the tailwind from negative real rates. And in case of a monetary reset, it protects part of my wealth. So gold then has a role in my portfolio long term. Does it mean I'm long gold right now? Nope, I'm tactically short gold right now because I expect real rates to move up. They have already moved up some 30 to 40 basis points year to date. So there can always be a difference between the tactical approach and the long-term approach. Those don't always match. So tactically, I'm afraid that Tony and I do not fully agree. So for instance, as you could read on the Macro Compass, I was, tactically a short real rates via tips, inflation break-evens, short gold, short Bitcoin, rather long dollar cash, or the safe side of the tech market. So let's say the quality tech names like Apple, they've also suffered. So I'm bleeding on that position, but I'm doing okay on others. So overall, it's doing okay. But as Tony is long, let's say the more cyclical side of the commodities sectors and short nominal rates, on those, let's say we don't agree, but it's fine not to agree, right? That's what makes a market.
Absolutely, and I couldn't agree more with you on, if I delineate, I'm a trader, Alf, and I've always made that clear, and I don't call myself much of an investor. But if there's one thing, that I kind of put in the same category as my 401k retirement plan, it is definitely my physical gold position, right? And that's definitely a place that we can overlap and say, over the long term, it makes sense to hold for several reasons, right? I mean, fiat currency risk, fiat currency hedge, hold physical metal for the possible continued, beating up of the dollar and the dollar's purchasing power. So that's one of the positions that I actually have on my view matrix that never goes away, is long physical gold. So I like that you brought that up. And if I'm able to think longer term and sort of, I always answer, if you woke me up in the middle of the night and I had no positions and I didn't know what was going on in the world, and you forced me to buy something, I would say, okay, I'll buy some gold.
Well, at the end of the day, until 1971, we used to have gold pegging credit creation, right? I mean, every time you wanted to print government deficits or banks wanted to expand credit to the real economy, they could, of course, but there was a peg to gold for every new dollar or euro, but there were no euros back then, but any dollar or any other fiat currency that was created effectively. And all of a sudden, we decided to ignore that after 1971. So we start expanding credit creation as much as we want effectively, because there is no hard peg to gold anymore, but there is still a soft peg to gold anymore, as I like to say. And at some point, it might be that the monetary reset comes, and therefore you want to own some position, I think, structurally in your long-term portfolio, which doesn't mean you can't be short tactically. People should not confuse a tactical view and a long-term asset allocation. I have a more pressing question for you, Tony, on 2022, because I think this can drive a lot of your performance in your long cyclical commodities asset allocation, which is, what's your take on inflation break-evens for 2022?
I still think that they're going to be driven higher, and most of that, I think that if I'm able to zoom the lens out a little bit, Alf, where you look at where sort of break-evens and yields bottomed during the lockdowns, and were sort of held down artificially, if we can use that word, even though they were held down for a reason, but break-evens and yields were pinned to the zero boundaries essentially for so long. And now last year was the year that they really started getting off the mat, right? And they're getting off the mat coming into a potentially inflationary environment for commodities. So that's why I think break-evens are going to continue to be driven, even if tech backs off. Who cares, right? Like, big tech is overvalued. It's priced to deity, right? It's priced to be behaving like the market gods. So if it backs off, it's probably something that makes sense. So the break-evens to me are going to be driven by the commodity inflation that I think is set up to have one of the best years that it's had in a long time. We've got structural deficits in, I won't say structural deficits. We have low inventories across the base metals markets in copper and aluminum. That's extremely relevant. We've got low inventories in gasoline and a lot of the products here in the US. Very low inventories in Europe. In fact, we found out today much lower than we thought. So there's going to be a necessary bid to the fossil fuel energy complex. And if we are going to pivot toward carbon neutral, and ESG, there's obviously going to have to be a bid to the base metals complex, because you have to build your electronic infrastructure and your battery packs out of something. So I'm still contesting that those are going to be the drivers of inflation, those commodity, the dearness of commodities, the structural tightness, and the pivot into ESG without tremendous commodity stocks, right? So we're going to go in and we're going to have to build these power charging stations all over the place and tremendous battery capacity. And we don't have a lot of copper and aluminum on the shelves. We're going to be buying our lithium and rare earths mostly from China, so we don't have pricing power. To me, all that stuff is really inflationary, Alf. So I can see break evens remaining in the uptrend basis, having them come off this flat line for such a long time, and the fact that I think commodities are in a good enough condition of their own that they can rally.
So I'm so happy that you made this analysis, Tony, because it perfectly proves the point that cyclical and structural views can be pretty different from each other. So what Tony's here bringing to the table is a picture for the next decade, maybe 2 decades. The zero net emission target is actually going to be potentially met, or the target is to meet it between 2040 and 2050. So we're talking 20 to 30 years down the road. And on the Macro Compass newsletter, I also posted a chart that shows the estimate for copper consumption or nickel consumption, for example, required in order to meet the net zero emission target. It's ridiculous. It's uber high compared to what we are doing these days, right? So if you expect these sort of long-term drivers, this is a structural view you can hold. That doesn't mean that cyclically you cannot have large drawdowns in these cyclical commodities that you can trade from the bearish side too. So that's the cyclical part, and there is a structural side, and those views can sometimes differ, but it just depends on the time horizon, right?
That is really beautifully stated, Alf. I mean, really well stated, because one of my themes for this year is don't forget to make sales on rallies. Right. And I say that a lot more this year than I did last year, because I think this year, if we're going to be tackling inflation, the path higher is not going to be linear. Right. And the path higher in commodities is going to have, all of a sudden, it's going to be weighed by a lot of speculative interest is going to happen. Right. We're going to push the commitment of traders' positions all the way to overbought long. Right. And that's when you have to say, OK, I better be the first one out of here. Otherwise, I have no idea where I'm going to be selling my oil or my other commodities. So that's one of the things that, while commodities are trending well above their moving averages this year, instead of sitting back and letting them go to the next level in 2022, I'm going to make sure that I feed the ducks a lot more often, so that, as you say, when the positioning gets overdone and the natural resources are due for a fall within that cyclical trade, I don't have to get beat up on the slide, and I can sit there and bid for them when they back off. So I agree with you that it's going to be a volatile year, and a lot of speculative positioning is going to come into play in the commodity space this year.
Be nimble, guys. Be nimble. Thanks, Tony, for a great daily briefing. And thanks again, everybody, for watching the Real Vision Daily Briefing. Actually, I'll be back tomorrow again, so get used to me. I'm going to be here online with Darius Dale. We're going to talk about the CPI print, which is going to be the highlight of the day for sure tomorrow. And as always, the conversation continues on the exchange. Thanks, Tony, for this interview.
Alf, great job. Great job today. I really enjoyed this conversation.
See you soon, guys.